Welcome to Financial Empires, where history, money, and power are examined through facts, systems, and long-term consequences. This documentary explores the rise and fall of Wall Street giants, not as isolated failures or successes, but as a continuous cycle shaped by ambition, innovation, regulation, and human behavior. Wall Street did not become powerful overnight, and its giants did not fall by accident. Their stories are deeply connected to the economic history of the United States and the structure of modern capitalism. Wall Street's origins are modest compared to its modern image. The street itself began in the late 17th century as a simple boundary in New Amsterdam, a Dutch settlement that later became New York City. It was not finance that defined the area, but trade. Merchants gathered to exchange goods, currencies, and agreements. Trust and reputation were essential, as formal institutions were limited. These early exchanges laid the cultural foundation for American finance, built on negotiation, private contracts, and risk-taking. The true transformation of Wall Street began after the American Revolution. The new United States faced enormous financial challenges. War debts were high, creditworthiness was weak, and the nation lacked a unified financial system. The issuance and trading of government bonds became one of the earliest financial activities in the country. These bonds were essential to stabilizing the young nation, and their trading created the first organized securities market in America. In 1792, a small group of brokers formalized this market by signing the Buttonwood Agreement. This agreement established rules for trading securities and commissions, creating the foundation for what would eventually become the New York Stock Exchange. At this stage, Wall Street was not dominated by speculation. Its primary function was to raise capital for government and infrastructure. Finance was closely linked to national development, and markets were seen as tools for progress rather than vehicles for excess. As the United States expanded westward in the 19th century, Wall Street grew in parallel. Railroads became the most significant investment opportunity of the era. They required enormous capital, far beyond what individual investors could provide. Investment banks emerged as intermediaries, pooling capital and distributing risk. Wall Street became the engine that financed industrial expansion, urban growth, and technological innovation. This period gave rise to America's first financial giants. Figures such as J.P. Morgan were not merely bankers. They were power brokers. Morgan's firm financed railroads, steel companies, and utilities, often consolidating industries to reduce competition and stabilize profits. While critics accused these financiers of monopolistic behavior, supporters argued that they brought order to chaotic markets. What was clear, however, was that financial power was concentrating in fewer hands. The late 19th and early 20th centuries marked the emergence of Wall Street as a national authority. Banks were no longer passive lenders. They actively shaped corporate strategy, mergers, and industrial policy. Financial institutions influenced which companies survived and which failed. This concentration of power created efficiency, but it also introduced systemic risk. When large institutions made mistakes, the consequences extended far beyond individual firms. The Panic of 1907 revealed these dangers. A failed attempt to manipulate the stock of a major company triggered a banking crisis that spread rapidly. Trust collapsed, liquidity vanished, and the financial system teetered on the edge of failure. There was no central bank to intervene. Instead, it was J.P. Morgan who organized private bankers to provide emergency funding. This episode demonstrated that Wall Street giants had become essential to national stability, a role that was both powerful and dangerous. In response to this crisis, the Federal Reserve System was created in 1913. Its purpose was to provide stability, regulate banks, and act as a lender of last resort. This marked a new phase in Wall Street's evolution. Financial power was now shared between private institutions and the federal government. Regulation increased, but so did confidence. Markets expanded under the assumption that catastrophic failures could now be controlled. The 1920s represented the first true era of mass participation in Wall Street. Economic growth, technological innovation, and rising incomes encouraged millions of Americans to invest in stocks. Brokerage accounts expanded rapidly. Margin trading, which allowed investors to borrow money to buy stocks, became widespread. Wall Street giants benefited enormously from this activity. Profits surged, and financial firms grew rapidly. This period also marked a cultural shift. Wall Street was no longer seen as a specialized financial center. It became a symbol of opportunity and success. Newspapers celebrated market gains. Speculation was normalized. The belief that markets could only rise became widespread. Financial institutions, driven by competition and profit incentives, did little to restrain excess. The stock market crash of 1929 ended this illusion abruptly. Market values collapsed, wiping out savings and destroying confidence. Banks that had invested heavily in the market failed. Wall Street giants that once appeared invincible faced insolvency. The crash triggered the Great Depression, the most severe economic crisis in American history. Public trust in Wall Street collapsed. Financial elites were blamed for reckless behavior, manipulation, and greed. In response, the U.S. government enacted sweeping reforms. The Glass-Steagall Act separated commercial banking from investment banking. Securities markets were regulated. Transparency and accountability became priorities. Wall Street survived, but its freedom was significantly reduced. For several decades after World War II, Wall Street operated under these constraints. The U.S. economy grew steadily, and financial institutions focused on traditional banking and long-term investment. This period is often described as an era of stability. However, beneath the surface, pressures were building. Global competition increased, innovation accelerated, and financial firms sought ways to expand profits beyond regulatory limits. By the 1970s and 1980s, deregulation reshaped Wall Street once again. Restrictions were relaxed. New financial instruments emerged. Investment banks expanded their activities into trading, derivatives, and complex structured products. Compensation structures changed, rewarding short-term gains over long-term stability. Wall Street giants grew larger, more aggressive, and more interconnected. This transformation marked the beginning of the modern Wall Street era. Finance became increasingly detached from the real economy. Profits were generated through leverage, speed, and complexity. Risk was spread across institutions in ways that were poorly understood. The belief returned that advanced models and innovation had eliminated the possibility of collapse. Part 1 of this story ends here, at the moment when Wall Street giants stood at the height of their power, confident in their systems, respected by governments, and deeply embedded in the global economy. The forces that would eventually lead to their fall were already present, but largely ignored. In the next phase of this documentary, these forces will move from the background to the center of the story, revealing how ambition, innovation, and neglect combined to bring some of the largest financial institutions in history to their knees. Part 2. After World War II, Wall Street entered what many consider its most influential era. The United States emerged from the war with its industrial base intact, its currency dominant, and its financial institutions stronger than any in the world. While Europe and Asia focused on rebuilding, American banks, investment firms, and corporations expanded rapidly. Wall Street became the financial center of the global economy, and its institutions were no longer national actors, but international forces. The Bretton Woods system placed the U.S. dollar at the center of global finance, linking other currencies to it and anchoring the dollar to gold. This arrangement gave Wall Street a privileged position. American banks handled international trade, managed global capital flows, and advised foreign governments. Confidence in U.S. financial institutions was high, and regulation provided a sense of stability. Banking was considered conservative, respectable, and essential to economic growth. During this period, Wall Street giants focused on long-term investment rather than speculation. Commercial banks funded businesses and infrastructure. Investment banks advised on mergers, acquisitions, and public offerings. Profit margins were stable rather than explosive. The separation between commercial and investment banking limited risk-taking and reduced conflicts of interest. This structure allowed financial institutions to grow steadily without threatening systemic stability. However, as the global economy became more complex, pressure mounted to loosen restrictions. Inflation in the 1970s, combined with slower growth and increased competition, challenged traditional banking models. Financial firms sought new ways to increase profits. Innovation accelerated, and Wall Street began to change its character. The focus shifted from patient capital to financial engineering. By the 1980s, deregulation reshaped the industry. Interest rate controls were removed, capital markets expanded, and competition intensified. Investment banks grew in size and influence. Trading desks became profit centers. New financial instruments, including futures, options, and early derivatives, allowed firms to manage risk but also to amplify it. Compensation structures rewarded aggressive behavior, reinforcing a culture of short-term performance. Wall Street's golden age was marked by confidence bordering on arrogance. Financial models promised precision, risk appeared measurable and manageable. Markets were increasingly dominated by large institutions whose scale gave them advantages over smaller competitors. Mergers created financial conglomerates that combined banking, trading, and investment services. These giants were celebrated as symbols of American innovation and efficiency. Part 3: Wall Street giants expanded. Their business models became increasingly dependent on leverage. Borrowed money amplified profits during good times, but magnified losses during downturns. Leverage was justified through complex models that assumed market stability and rational behavior. Risk management became a technical exercise rather than a philosophical one. The rise of mortgage-backed securities marked a turning point. Home loans were bundled, repackaged, and sold as investments. This process was presented as a way to spread risk, but in reality, it obscured it. Investment banks earned fees at every stage, creating incentives to increase volume rather than quality. Credit rating agencies assigned high ratings to complex products they barely understood. Wall Street giants grew deeply interconnected. Banks lent to one another, traded with one another, and held similar assets. This interconnectedness created the illusion of stability but actually increased vulnerability. When one institution faltered, the impact spread rapidly across the system. Despite warning signs, confidence remained high. Profits were strong, bonuses were enormous, and competition discouraged caution. Regulatory oversight failed to keep pace with innovation. Complex products operated in gray areas beyond traditional rules. Risk accumulated quietly. Housing prices rose steadily, reinforcing the belief that losses were unlikely. Financial institutions relied on short-term funding, assuming markets would always provide liquidity. This assumption would soon prove catastrophic. The culture of Wall Street during this period prioritized speed, scale, and profit. Ethical considerations were secondary. Responsibility was diffuse. Decisions were justified through models rather than judgment. The system rewarded those who pushed limits and punished those who questioned them. Wall Street giants had become too large, too complex, and too confident to recognize their own fragility. Part 04, the financial crisis of 2008, exposed the structural weaknesses of Wall Street. When housing prices began to fall, mortgage-backed securities lost value. Confidence evaporated. Institutions that depended on constant borrowing faced immediate liquidity shortages. Lehman Brothers collapsed, sending shockwaves through global markets. Bear Stearns disappeared. Merrill Lynch was absorbed. Giants that once defined Wall Street ceased to exist in their original form. The collapse revealed the true scale of interconnected risk. Markets froze. Credit vanished. Governments intervened on an unprecedented scale. Trillions of dollars were deployed to stabilize the system. Central banks became the ultimate backstop. The message was clear. Wall Street giants were not allowed to fail completely, because their failure threatened the entire economy. Public outrage followed. Trust in financial institutions reached historic lows. Executives faced criticism for excessive risk-taking and moral hazard, yet despite reforms, many core structures remained intact. New regulations increased capital requirements and oversight, but the fundamental role of Wall Street as the center of global finance was preserved. In the aftermath, Wall Street adapted. Institutions became larger through consolidation. Trading evolved. Technology reshaped markets. While some giants fell, others emerged stronger. The cycle of rise, excess, and correction continued. The system survived, not because it was flawless, but because it was deeply embedded in the global economy. The rise and fall of Wall Street giants is not a closed chapter. It is an ongoing process shaped by incentives, innovation, and human behavior. Power concentrates, risk accumulates, and crises reset the system. Understanding this cycle is essential for understanding modern capitalism. This story is not about villains or heroes. It is about structures, choices, and consequences. Wall Street reflects the values and contradictions of the society it serves. Its giants rise when confidence is high and fall when discipline fails. The lesson is not that finance is evil, but that unchecked power, whether financial or political, carries unavoidable risk. Part 05, The Fall of Wall Street Giants, did not mark the end of financial dominance in the United States. Instead, it marked a transformation. History shows that Wall Street does not disappear after crises. It evolves. Institutions collapse, names vanish. But the system adapts, reshapes itself, and often emerges even more deeply embedded in the economy than before. The aftermath of major financial crises reveals an uncomfortable truth. Wall Street's power is not only financial, it is structural. After the 2008 financial crisis, governments and regulators promised fundamental change. New laws were introduced, capital requirements were raised, and oversight was expanded. The goal was to prevent excessive risk-taking and reduce the likelihood of another systemic collapse. On the surface, these reforms appeared strong. Banks were required to hold more capital, stress tests became routine, and transparency improved in certain areas of the market. However, deeper examination shows that the core incentives driving Wall Street behavior remained largely unchanged. Profit maximization, competitive pressure, and the pursuit of growth continued to define institutional culture. While some activities moved out of traditional banks and into hedge funds, private equity firms, and shadow banking systems, the overall level of risk in the financial system did not disappear. It simply changed form. One of the most significant lessons of Wall Street's rise and fall is the concept of moral hazard. When institutions believe they are too important to fail, they are more likely to take extreme risks. The rescue of major financial firms during crises reinforced this belief. While these interventions prevented total economic collapse, they also sent a powerful signal. Losses could be socialized, while gains remained private. This dynamic reshaped public perception. Trust in financial institutions declined sharply. Many Americans questioned a system in which ordinary citizens suffered job losses, home foreclosures, and declining living standards, while executives often escaped with wealth intact. Wall Street became a symbol not only of financial power, but of inequality and imbalance within the economic system. At the same time, Wall Street's influence over global finance grew stronger. The U.S. dollar retained its dominant role. American financial markets remained the deepest and most liquid in the world. International capital continued to flow through New York. Despite repeated crises, global investors still viewed U.S. financial institutions as essential to stability. This paradox lies at the heart of Wall Street's enduring power. It is both a source of risk and a pillar of the global system. Technology further transformed Wall Street in the years following the crisis. High-frequency trading, algorithms, artificial intelligence, and data-driven strategies reshaped markets. Decisions once made by individuals were increasingly made by machines. Speed replaced judgment. Volume replaced patience. This technological shift increased efficiency but also introduced new vulnerabilities. Market shocks could now spread faster than ever before. Another critical lesson is that regulation often follows crisis, not foresight. Financial innovation consistently moves faster than oversight. Complex products, new markets, and unconventional strategies emerge in spaces where rules are unclear. By the time risks become visible, damage is often already done. This pattern has repeated throughout Wall Street's history, from early speculation to modern derivatives. The legacy of Wall Street giants is therefore mixed. They financed innovation, built infrastructure, supported growth, and connected global markets. At the same time, they amplified inequality, encouraged speculation, and contributed to repeated economic instability. Their rise created opportunity, but their excess imposed costs that extended far beyond financial markets. Looking forward, the future of Wall Street will likely follow the same historical cycle. Power will concentrate, innovation will accelerate, and risk will accumulate. New giants will rise, possibly under different names and technologies, but driven by familiar incentives. Digital assets, decentralized finance, and global capital platforms may change the appearance of finance, but not its fundamental dynamics. The most important lesson is not that Wall Street must be destroyed or glorified, it is that financial power must be understood. Markets are not neutral forces. They reflect human choices, institutional incentives, and political decisions. When left unchecked, they tend toward concentration and excess. When balanced with accountability and transparency, they can support long-term prosperity. The rise and fall of Wall Street giants is ultimately a story about systems, not individuals. It shows how ambition, confidence, innovation, and neglect combine to shape economic history. It reminds us that financial empires are not permanent. They rise when trust is high and discipline is strong, and they fall when confidence replaces caution. Understanding this history is essential for anyone who wants to understand the modern world. Wall Street is not just a place. It is a force that influences jobs, governments, currencies, and lives across the globe. Its decisions ripple far beyond trading floors, affecting societies in ways that are often invisible until crisis strikes. This is why stories like this matter. If you want to understand how money shapes nations, how power moves silently through markets, and how financial empires rise and fall, then Financial Empires is your place. Subscribe to the channel, like this video, and share it with those who want more than headlines. Here, we do not chase trends. We study the systems behind them. Because when you understand financial history, you begin to see the future more clearly.